How many people in the watching this live stream right now have struggled trying to figure out what the after repair value is on a property? And this is huge too. So it's really important that we understand, like, in theory, after repair value should really just be one concept. Like, it should really just be one value. But in fact, I really like to view it as a spectrum, because depending on what investment strategy you're really focused on, depending on what your exit strategy is for that property, how you approach ARV and how you estimate your ARV is actually going to be a little bit different. ARV minus profit margin equals the total maximum cost for the property. So for example, that flipper, say my buddy Sean Allen, he really wants to get $28,000 from a flip project. So what that means is he's going to take his ARV, subtract. What is up, YouTube? In today's video, I'm going to be breaking down for you how to calculate ARV, that's after repair value. This is a really important metric to be able to understand as a real estate investor. It doesn't matter whether you're a wholesaler, a flipper, a BRRRR investor, whether you're doing rent to owns, you really need to understand the after repair value of your real estate investment. So we're going to break it down for you in today's video. This is a sampling of what you can expect with Cashflow Tribe.
Cashflow Tribe.
That's the new education company, the new community, the new tribe I'm really trying to create. I think Canadian real estate investors need a community to belong to, and we're trying to create that with Cashflow Tribe. So I recommend you guys check it out, but here's some free training from Cashflow Tribe.
Cashflow Tribe.
But let's dive into calculating ARV. So calculating after repair value. Really, this is being able to calculate after repair value. ARV is critical to your success as a real estate investor, regardless of what strategy you're focused on. And ARV is one of those things that I find a lot of investors really struggle with, the idea of how do I go about determining, what the market value of a property is. And I understand why. It's so critical to our business model that we understand after repair value, because if we don't get that number right, everything else through the entire process, whether we're a wholesaler, a flipper, or a BRRRR investor, is going to be a real struggle, because we're really building a framework around that after repair value. How many people in the watching this live stream right now have struggled trying to figure out what the after repair value is on a property? Let me know if this is a common issue for everyone. Oh, and I see we got the humble CEO Ben's in the comment section as well. So calculating after repair value. After repair value can mean different things depending upon the context as an investment strategy. And this is huge too. So it's really important that we understand, like, in theory, after repair value should really just be one concept. Like, it should really just be one value. But in fact, I really like to view it as a spectrum, because depending on what investment strategy you're really focused on, depending on what your exit strategy is for that property, how you approach ARV and how you estimate your ARV is actually going to be a little bit different. So let's talk about how it works for a flipper. Well, for a flipper, after repair value is really focused on what will the market, aka another buyer, be willing to pay for this property once you have it fixed up, once you've done all your renovations, once you've done, you've got it done to the nines. What is someone willing to pay? If you guys are having any issues, I see Christina's mentioning she's having audio issues. If you ever have any issues, whether the live stream's freezing, the audio's not working, you can always just restart your browser or refresh this page, and it should work. That's usually the trick here. And if for whatever reason you can't get this one working, don't panic. We always record these, as long as I remember to record them, and I have this time, thankfully. And you can always jump in and watch the replay, because Vinny's very fast at getting that up there for us. So again, as a flipper, what the market will bear, what the market will pay for the property, that's really what we're looking at as far as flipping goes. Now, ARV for a BRRRR investor, that's really what an appraiser is going to value this property at, and what your lender will value it at. A lot of real estate investors, myself included, are really actually quite frustrated with appraisers when it comes to how they go about evaluating their properties, because oftentimes if it's a refinance, especially over a short period of time, you may not get the same value as you would if you were to put it on the market, especially in really hot markets where often we're looking at multiple offers. What that means is oftentimes a flipper can actually get a higher ARV, let's say, than a BRRRR investor would. However, it can be the reverse as well. So that's why it's really important we understand what your exact investment strategy is when you're trying to figure out what your ARV is going to be. Then ARV for large multifamily investors, this is driven by different metrics quite often. And in hot markets, again, where there's a lot of demand for properties, where cap rates are really being pushed down, it's really going to be driven by income. And then finally, we may also have to look at what a buyer is willing to pay may be different than what an appraiser or bank will value it at. So that's kind of what I've been mentioning throughout here. It's really important you guys understand when we're talking about ARV, your investment strategy will actually impact what you're going to want to consider to be your true after repair value, or what the market value is on the property. Make sense? I know it's kind of a little weird at first to think about that, but it really is the way it works. Oftentimes, flippers are going to be able to get the highest ARV on a property. You could literally do the exact same finishes on a property and be BRRRRing it, and you may not get the appraisal quite as high as if you were to list it on the market and have someone actually buy it, a different party, versus refinancing it. So flippers business model. Now we're just going to kind of dive into why after repair value matters for flippers. So after repair value minus your profit margin is going to equal the total maximum cost for the property, including purchase price, renovations, holding and closing costs, and selling costs. So, for example, a flipper wants to make $30K before they'll do a deal. This is quite a good real-life example. In fact, over this weekend, Ben was kind of mentioning that that's kind of a metric he really looks at. I know it's also a metric that my buddy Sean Allen really focuses on. Essentially, for any flip to be of interest to him, he wants to make sure he's going to walk away with, I don't know why, but exactly $28,000. If he's not going to walk away with $28,000 or more, he's not interested. Sounds like a very specific number. I should maybe sit down with him sometime. And, Allison, there you go. If you want to really quickly just take a screenshot. Again, guys, we always throw these slides up the day after. So Vinny's really good at doing that for everyone. But ARV minus profit margin equals the total maximum cost for the property. So, for example, that flipper, say my buddy Sean Allen, he really wants to get $28,000 from a flip project. So what that means is he's going to take his ARV, subtract 28,000, or let's call it 30,000 because I like round numbers, subtract the selling costs. So often as a flipper, when you're looking at selling costs, obviously we're going to be dealing with things like your lawyer's costs, but even more importantly, and a bigger fee, is likely going to be your realtor commission. What's very common here in Ontario, Canada, is somewhere between 4 and 5%, with I'd say 4.5% being extremely common, at least in London, Ontario. So then, for example, kind of breaking this down into more specific numbers, what we can see is, let's say that we expect the ARV to be 400,000. Well, if we want our margin to be 30,000, then we're subtracting 30,000, subtract 20,000, subtract 40,000. So I guess maybe I'm not explaining this well. ARV 400,000, subtract 30,000, which is our profit margin, subtract 20,000, which is going to be our selling cost. So essentially, in general, I like to consider selling costs 5% of the overall sale price. And the reason for that is usually I can get the realtor cost to be 4 or 4.5% on my properties. And then that little 0.5% is going to cover the lawyer, legal fees, any random little miscellaneous costs that are associated with selling the property. In this case, this is a made up example, obviously, but let's pretend renovations we expect are going to cost $40,000 to get the property up to the $400,000 ARV price, and then subtract holding and closing costs. So obviously our closing costs are going to be things like land transfer tax. It's going to be things like our legal fees when we buy the property, any sort of home inspection, anything of that nature. And then holding costs, obviously, you've got interest expense, property taxes, insurance, utilities, all that great stuff. So in this case, with an ARV of 400,000 on this theoretical property, minus 30, minus 20, minus 40, minus 10 means that we'd be willing to do a purchase price of $300,000 on this example property. So then kind of moving on here to show you how this maybe would impact a wholesaler looking to sell to a flipper. The business model, again, very similar. That flipper still wants to make their $30,000. They honestly don't care whether they're buying from, say, a flipper, whether they're buying from a wholesaler, whether they're buying from a realtor, or they're just buying, from a for sale by owner. Doesn't really matter, not going to impact their business model. So you can see I've broken down the same formula here, but the real difference is what we're going to have our ARV still equals the 400 minus 30 minus 20 minus 40 minus 10, but then that has to equal our purchase price plus wholesale fee for a total of 300,000. So I'm just going to jump back a slide. You can see at the end of the day, the business model is the exact same. Really, the difference is going to be the wholesaler is going to find perhaps a unique opportunity, and if they can get this property for less than 300,000, then they can turn around and sell it to the flipper for 300,000. So whether they're getting it for 295 or 205 in theory, that same flipper should be comfortable paying $300,000 for the property because it fits within their model. Now, obviously, that's not always the case that we'll find as a real estate investor. Oftentimes, once people start seeing what we're expected to be paid, what we expect to make on the deal as a wholesaler, sometimes they may give pushback. But this is where understanding your ARV is so critical as a wholesaler. You need to stand your ground. If you know that you've got all your numbers right in this situation, then you can stand with confidence and say, look, Mr. Flipper, you told me that you want to make $30,000 on any deal. Do you disagree with what I've estimated the selling cost to be? Do you disagree with what I've estimated the renovation cost to be? Do you disagree with what I've estimated the holding and closing cost to be? If not, what I've got the deal under contract for should not truly impact you or your business model. You're still going to make $30,000. So whether you paid the seller $300,000 or $200,000 and myself, the wholesaler, $100,000 should not make a lick of difference to your business model. So that's why understanding ARV is so important, because if you don't know what ARV is, especially as a beginner wholesaler, you're really going to get beat up when it comes to your fee, and you're just going to constantly have flippers kind of, turning the screws on you, really trying to force you to discount your property, discount the value of all your labor, which really isn't fair. If you've been spending a lot of time, there's a lot of risk involved with being a wholesaler. And by risk, I simply mean like there's no guarantees, right? Like you're going to probably do all sorts of marketing campaigns that may cost you money, or if not, you're going to do marketing campaigns that cost you a lot of time. And regardless, that's a risk you're taking on without knowing that you're going to be guaranteed that reward. And a lot of wholesalers, in fact, struggle because they don't go the entire distance. So they spend all this work learning, they start up their marketing funnels, they start their deal pipeline, but then they end up giving up before they actually ever convert and get that first deal. And I think a big struggle for a lot of first-time wholesalers is not understanding what the after repair value is on a property. So let's compare this now. Essentially, we're going to look at theoretically the exact same property, but how does this impact a BRRRR investor? Well, in this case, a BRRRR investor that wants to do a perfect BRRRR, that's a deal where they're able to essentially refinance out 100% of the money they've put into the deal. They're going to want the after repair value times 80% to equal the total maximum cost for the property. So this includes everything. So it includes purchase price, wholesale fee, renovations, holding and closing costs, any costs associated with acquiring or getting that property up to the after repair value is going to be directly the cost that they can afford to do. So then, for example, a BRRRR who wants to do a perfect BRRRR deal, ARV times 80%, subtract the renovations, holding and closing costs equals the purchase price. So in this case, that $400,000 times 80%, subtract $40,000 for the exact same renovations, subtract $10,000 for the holding and closing costs equals a purchase price of $270,000. I know this is something that a lot of novice investors really struggle with. I'm going to jump back a slide just so we can compare this to the previous one. So the only difference here is you don't have that $20,000 in selling costs, because as a BRRRR investor, we're not actually disposing of the asset. So we're not going to incur the same legal costs that a flipper would. And we're obviously not going to incur the realtor costs of selling the property. So I see Daniel's asking, how many months of holding costs do you typically account for in your calcs? Honestly, it's really going to depend on the size and scope of the project, right? So deals where we're peeling everything back to the studs and, we're rewiring, we're replumbing, we're doing re-drywalling everything. That's going to be a massive project, a massive undertaking, and that's going to take months and months and months. However, a lipstick flip or a wholesale deal, there's a very good chance that you may be able to get in and out in, say, 30, 45, 60, 75, 90 days. So you're going to have to look at the scope and detail of work involved before really getting to the bottom of how long you expect to hold the property. I usually like to include a buffer period as well. One other difference is obviously if we're flipping the property, there's a little bit more volatility in how long we may have those holding costs, right? We can't guarantee when a seller's going to, or when a buyer's going to walk in and decide to buy our flipped property. Whereas with a burr investor, as soon as we're done our renovations, we can immediately turn around and refinance the property. So again, it's really going to depend on the exact nature of the deal. If you guys are interested in seeing a flip that I recently did that we did within 60 days, and maybe that'll help you understand, the scope of work there, we probably could have got it done a little bit faster. But in fact, we did sell the property very fast. You can jump over to my YouTube channel. We really break down for you a lot of the mistakes that my sister and Mike Nowicki, who's one of my full-time wholesalers, made on this first deal. It was both of their first times ever trying to flip a property. So they're both relatively new to the idea of real estate investing. Myself and Jeff Weibel were pretty hands-off in managing them and the deal as well. So it really is a great insight into some of the costs and the different holding costs that like we ended up doing on this property. Our biggest holding cost in this case was interest because we did a hard money loan. So it's really important that you understand, also your cost of borrowing, right? If you're getting a traditional mortgage at 2 or 3%, your cost of borrowing very insignificant. If we're turning to a hard money lender or getting sources of money for, like, say, a second mortgage in order to do this property, or an unsecured borrowing, especially if we're dealing with hard money, like we could be looking at 10, 15, 20% interest rate. That's dramatically different. So really just need to kind of break it down that way. So for a wholesale deal, really the only difference we're going to be looking at is, like, you're just not going to undertake much significant renovations, right? So realistically, we're still going to incur the exact same cost as a flipper other than the renovation cost. Probably the only cost for a wholesale that we're going to end up doing is, cleaning out the unit. Maybe at the most, you might slap a quick coat of paint on it, do some basic landscaping. But usually a wholesale, you're really just focused on clearing out the property, getting rid of all the junk, all the miscellaneous shit, and just like clearing up the yard and stuff. So moving on, there's the burr. So calculating after repair value. So let's look at how appraisers view properties. This is going to be really important, especially for burr investors, but even for flippers. So it's often going to be viewed as the lower of comparable sales, replacement value, or income-based approach if it's an investment property. So obviously this last one is not going to be applicable if you're just flipping a single family home that's going to go to, first-time buyers or retirees or anything of that nature. But if we're burring multifamilies or if we're flipping multifamilies, income-based approach is also a big factor that we need to take into consideration. Comparable sales. So remember, data, not drama. And our goal with comparable sales is really apples to apples comparison. So rarely are there going to be perfect comps, guys, when you're looking at trying to figure out what your ARV is. It'd be amazing if there are apple to apple comps, but unless you're in a subdivision with all cookie cutter houses with relatively the same finishes and renovations, or unless you're in a condo building, again, with pretty much the exact same unit, square footage, layouts, things of that nature, it's going to be rare to find that perfect comp. Because you'd have to find an identical property with an identical location in identical condition and sold very recently. So those are the different factors as a real estate investor we need to take in consideration when we're trying to get the closest thing we can to apples to apples comparisons. Generally, we will need to look at several relatively similar sales to determine an expected range for ARV. So that's one of the other things a lot of newer investors don't realize is ARV is not like this one static number. ARV is a little bit dynamic. It's actually more of a spectrum overall than really being just like one number. So in my previous examples there of saying 400,000, you know, that's just nice, clean presentation numbers. But realistically, you know, you're probably going to actually be thinking to yourself, well, this property probably is going to sell for between 380 and 420, and I hope it comes in at 400 or better. So comparable sales, factors that we need to consider. We need to look at the age of the building. So, you know, if you're looking at a recent sale and trying to use it as a comp, if it was built 50 or 60 years after your building, obviously we're not dealing with an apples to apples comparison. We also need to look at the style of home. So obviously, like, bungalow is different than a raised ranch, than a side split. There's a lot of different layouts there, and it's something that we need to be cognizant of as well. Then obviously square footage of the units, very important, or square footage of the property, I should say, is also a big factor. Then age and condition of the renovations and properties, also a big factor. So, you know, that property that's sold down the street for double the price of the property you're buying, that sounds great. But if it's got all brand new granite countertops and custom kitchen, and, you know, it's been done to the nine, steel roof, all new electrical, all new plumbing, all new HVAC, that's not an apples to apples comparison again. And then amenities, so things like garages, parking spaces, unique features, and landscaping, all as well can impact really what our apples to apples are going to look like. Then the lot size is also another big consideration. And then location and neighborhood, also huge factor. So just because you've got a house that looked similar and is almost identical, but it's on the other side of the city, or even just oftentimes like a few blocks can make a big difference depending on your exact market. It's really important we understand the location and neighborhood, that the comps that we're using as a basis, that we really understand the market fundamentals related to location there. Then other unique potentials, another big factor that novice investors may overlook. So just because that property down the street sold for triple the price of the property you're looking at, maybe it's got more favorable zoning. Maybe it will allow, you know, a more high density build, or maybe it allows like laneway carriage homes, or maybe there's the ability to sever a lot there, or maybe you have the room to be able to build an addition, or build an additional unit, or convert part of the property over into multiple units. So these are all different factors as a real estate investor that we're going to need to take in consideration when trying to narrow in exactly what our ARV is going to be. So Sean's asking, what is the best way to get ARV when there are no good comps? Yeah, again, we're just going to have to try and get the closest things we have, right? We just need to find whatever data is available to us. So you're going to want to look at different factors such as
Cashflow Tribe.
If you guys enjoyed this video, smash the like button. If you guys want to see a similar type of training video, check it out up here, or check out this playlist down there. And otherwise, if you guys are new to my channel, hit the subscribe button, hit the notification bell if you want to know when the next video is coming out, because we're doing 7 videos a week. That's a video every day, 366 this year, because we've got a leap year. I'll see you guys in the next video. Thanks.